Now that we've talked about the importance of working capital ratios, let's go over what a couple of them are. Now, working capital is equal to current assets minus current liabilities. And there's a lot of different types of these current assets and liabilities. The ones we tend to focus on, accounts receivable, and current liabilities tends to be accounts payable, and also current asset would be inventory. So there's three key ratios that you use to assess a company's profitability, or not their profitability, but their cash management. And it has to do with essentially companies that are reselling goods. Okay, so if we're looking at the turnover for each of these, so you have the accounts receivable turnover. Now all of these things are going to be measured in days. And the way we calculate that is it is the average accounts receivable divided by the annual sales times 365 days. Okay, so it'll give you a number, and that number could be like 40 days. And what that number is telling you is how long does it take for your customers to pay you. Okay, so naturally you want to keep that as low as possible. The longer you keep it, the more drain it's putting on your cash flow. The next one is accounts payable turnover. Also in days, so this is going to be accounts payable. Well, it's going to be average accounts payable. And it's divided now by the annual cost of goods sold. So not sales in this case, but because we're buying materials, so it's a cost of goods sold multiplied by 365 days. And this number is telling you how long it takes you to pay your suppliers. So it's nice to pay them early, but it puts a drain on your cash flow. So ideally you want to keep this as low as possible. And the third one is inventory turnover, also measured in days. And this is your average inventory during the year divided by the annual cost of goods sold times 365 days. And this is telling you how long it takes you to sell your inventory. So naturally, you want to keep this as low as possible as well, because the quicker you sell your inventory, the more cash you will be generating. You don't want it sitting around for an excessive period of time.